I think there's been a substantial impact. I mean, having an event where a huge proportion of the Australian economy was shut down is going to impact businesses. So we have seen where you have the shutdowns, businesses have no income when you do have the full shutdown. What has been really helpful in the space is obviously the government have stepped in with some fairly substantial measures to help small businesses through. So there were those businesses that were shut down, so particularly in the sort of hospitality area, tourism, accommodation, those areas were heavily impacted. But we have seen some businesses in the manufacturing space, in construction, particularly where you've got an infrastructure bent, in agriculture, where we've actually seen things accelerating for those businesses over time. So yeah, the businesses that were shut down have had a significant impact, but there are some who have traded exceptionally well throughout this period. I think for those that have been impacted, the government have been very, very helpful. We've had an interesting period in Australia where we had the bushfire event coming through in December. So the Australian economy has actually been dealing with some strain for over 6 months now. And what has been helpful to our underlying portfolio is that our loan managers and lenders have actually had to adapt to that. So coming into December, we already had some tightening of risk policies and risk appetites from our lenders. So we saw, particularly in areas where you had, coastal towns that were impacted by the bushfires, you saw that we had industry knockouts for accommodation, hospitality, those kind of high street retail is another one that we stopped new lending to back in December. So we had that tightening with the bushfires, bushfire experience throughout December. In January, we started to see some of the strains coming through to those businesses that had supply chain exposure up into China primarily. And what is good with dealing with some of the smaller lenders who aren't the banks, they can adapt their risk policies very quickly. So we started to see them knock out any new loans from businesses that had supply chain exposure to China. So we started to see no new exposures to those industries. Obviously, as we've come through, the risk appetites have reduced, and we've seen new lending reducing over time for the majority of our lenders. Prosper put out a report yesterday noting the same thing that we've been seeing in the market, where their new lending had dropped, but the focus has been on maintaining loss levels within their tolerance bands. So you're seeing a reduction in new loans going out the door, but the real focus in that risk management side of the business. Interestingly, our arrears have dropped in the last 3 months. So we saw a peak in February. And what we're seeing is that the adaptation from the lenders, where the focus has shifted from new loan origination into management of the existing portfolio. And we're seeing very robust arrears management processes from lenders where they're looking to help borrowers. I mean, they definitely see this as a period where if they help a small business through what is an unprecedented period, they will have a customer for life. So we've seen the management of the existing portfolios increasing, and we've seen that translate through to really positive data in our arrears set. What will happen as the government taper off their measures? Well, I think what we've seen, there's still a bit of dry powder out there from the government. In the Statement of Monetary Policy last week, we saw that the term funding facility from the banks had only been drawn to $6 billion, and that was a $90 billion program. Looking at the SFSF, which was the non-bank lending program, that was a $15 billion program. Based on the recent data that they've published on their website, it looks like they've agreed to around $2 billion worth of funding out there. So there's still a lot of headroom in those lending programs, which is positive. Also, the actual drawdowns in relation to the government guarantees out there are minimal. So there's still a lot of room for the government to move. With respect to the JobKeeper program, I think that is going to really depend on how the economy really reacts as we come out of the lockdown. So, we're seeing out here in Sydney today, more shops are open, there's more foot traffic out and about. People are returning to, what will be the new normal and are starting to spend the money. Business confidence is starting, has bounced back off lows. Consumer confidence is starting to come back off lows. So I think it'll really depend on the timing of, relaxation of lockdown measures mixed with that consumer confidence, how we react through this. So what we're really doing is focusing on those forward-looking indicators that, particularly with respect to confidence and purchasing managers indexes. And obviously we're going to see some of the backward-looking indicators, GDP figures coming through. We've already had, the Treasurer state that we are in a recession. And those backward-looking indicators are basically going to tell us what we already know. It was a horrible quarter, from March through to May. But those forward-looking indicators are looking more promising.